Now we turn towards U.S. trade, and we want to look at what is happening in the trade market, imports, exports, what's happening on the Federal Reserve level, central bank level. And here you can see that we've had a pressure in terms of just total imports overall, where we've started to get back to normal, but again, it's that lower normal where we see some of the imports, starting to normalize. But we have to. This is looking at just the commodity levels, some of the raw materials that we need, some of the semi-finished goods that we need. So you're seeing that we're kind of normalizing at that lower point as the trend has been down from 2018 into 2020. And then we're going to look at the total volume of goods averaging. So here's just where that pressure really resides. When we look at that intermodal, when we look at shipping, this is what we're talking about when we see some of those pressures. Now given it's better than it was in terms of how we started the year, given COVID issues and whatnot, but we're still off of that normal. So when we do a kind of a closer dive and look at U.S. imports January through August, trying to compare more apples to apples, going back to 2015. You can see how far off we are in terms of just where we sit for the current part of this year. Given just where inherent demand is, where the consumer sits, where things are flowing, it's going to be hard to close that gap. Now, it doesn't mean that we can't get closer to 2019. The question is going to be how close, because in 2019, we still had the trade war. We still had overhangs and issues going through. The question is going to be as we go forward, which is just going to be that overhang, which again, 2019 did get better towards the end of the year, and 2020 we're seeing some increase in exports, which we're going to talk about. And when we have our food inflation show and kind of go through, exports and food, but the import side remains lackluster as the consumer continues to struggle, and we have the U.S. dollar, maintaining some of those headwinds. So it just means that we can't buy as much for as many dollars, which again is that overhang. And then looking at the volume of goods arriving at all U.S. ports across all goods, you can see the trajectory overall has been down. And it's just, this is looking at that 4-week moving average. Now we had a little bit of a turn higher, as you can kind of see, but again, it's just going to be kind of bumping along those sidelines because we just don't have the same type of demand that I think a lot of people were expecting for that V-shaped recovery as we went through the remainder of the year. Looking at the Eurozone industrial production, just because when you think about, all right, the Eurozone what is the production? What is that going to lead to into the U.S.? What is their demand going to be for imports overall? So here, the survey for Eurozone industrial production was down 8.1%, and it actually came in down 7.7%. So it was a little bit of a surprise to the upside across the total Eurozone. The bigger issue here is France and Italy continue to kind of slow down a little bit. So we've had a nice bounce off the bottom, but you see Germany kind of leveling off, and now we're having France slow down a bit. But again, they're not going to slow down to the levels that we've seen. It's just more of getting to that aggregate of, call it 87 to 90% normalcy, which is going to be a little bit of an overhang on the Eurozone industrial production as we go forward. And the reason why we can say that, and we're saying that more, is because, again, like credit conditions continue to worsen for non-financial companies in the Eurozone. So this is when we're looking at those tightening credit conditions, which we talked about in previous shows, which we talked about in the US, and it's continuing to happen within Europe itself, which just means that you don't have the money to build new equipment, to increase CapEx, to maybe hire back people. So that's why we think some of this industrial production, while it was a nice bounce, it's just going to kind of level off as the ability to get some of these loans and additional capital just isn't there. And that's when we just look at total credit conditions for the household. So the first one is looking at can the business get. Now we're going to look at what can the household, what can the consumer get. And here you can see that we're getting a tightness across the board. And just looking at it from the perspective of mortgages, but also consumer credit. So not only is the mortgage struggling, but also the consumer credit is struggling. And the consumer credit is starting to follow that move, which again is just going to lead to additional slowdowns in consumer spending within Europe, which is just going to put additional weight and additional pressure throughout essentially throughout the world, because this is something that is happening not only in the US, but in Europe and in parts of Asia, which is just going to be that overhang. Now, while all this pressure continues, we keep seeing the Federal Reserve continuing to do its thing and to spend, and the Federal Reserve isn't alone. We're seeing it with the ECB. We had additional commentary saying that things are getting. They're going to continue at the course of business. The BOJ continues to purchase assets, put yen into the market. The Federal Reserve, we have the Federal Reserve meeting in a couple minutes. We're going to get a little bit more updates. Again, there's nothing to say that they're going to change course. We're not getting the fiscal stimulus, so they're going to maintain their monetary stimulus, which again is just going to keep that balance sheet moving in the upward trajectory, which is just going to be just kind of showing you the overhang, but yet, the market and stocks remain near or at all-time highs because we keep getting this support, which is being dumped directly into the market. And then the question is, who owns the debt? Because right now we see all this debt getting thrown out there. We see a lot of this debt getting purchased. So the U.S. investor, the Federal Reserve is continuing to grow. The Federal Reserve now owns $4.4 trillion worth of U.S. debt, and that's increasing overall. And you can see who owns the most, China being one of them. China has talked about that they want to walk back their ownership from about 1 to 1.1 trillion to about 800 billion, which again, based on this, the Federal Reserve can easily buy it. But it's just a matter of, well, why are they doing that? What are the issues that are going on right there? Because China continues to struggle in terms of just what their foreign reserves look like, which is why when we talk about trade, we have to talk about China. We have to look at, okay, well, what is happening in China? What's going on there? But again, these are issues that continue to arise as we look at what the Fed is doing, but they continue to say that there is no inflation. So because there's no inflation, or at least very low inflation, they can just come out and say, well, that means that we can continue to ease. And that's when we look at core CPI. So CPI, which is the consumer price index, the survey was for 1.6. We came in at 1.7. We can continue to kind of drift higher. The question is, how is this calculated? Because the calculation doesn't weight things, the way it really should, given how people consume, given how people spend. So that's when we've heard people talk, we've seen articles put out. Most recent one came from Harvard, looking at the kind of that price distortion. That COVID inflation rate is actually higher than the official rate. So when we look at what is the COVID CPI, this as we can see, the professor here is putting it closer to 2%. We've heard things as high as 4.5%. It's probably somewhere in the middle if you consider, where things are in terms of spending on healthcare, on rent. Now, rents will come down just given the amount of supply coming into the market, which will be a benefit in terms of kind of flattening out what those expectations are. But again, it's going to come down to these differentiating pressures. We have some deflationary pressures in the market, but we also have inflationary pressure in the market. And that's something that we're going to go through in a bit more detail in a separate show, just because of the complexity and just inherent pieces that are kind of moving different sides of that equation. But here we really want to understand, what are central banks doing on policy levels across the board? And when you look at just the U.S. as a whole, you can see that we've essentially put into place everything that we've tried. Yield control, they're saying that we haven't done. Depending on how you want to consider, okay, well, what is happening for Operation Twist? What does that mean? Was that yield control? Was that duration control? Again, call it what you may. Here you can see what has happened overall in terms of government bonds, what's happening in terms of forward guidance, which should happen, make sense. Asset-backed securities, they're buying commercial paper, we're buying corporate bonds, we're buying government bonds, we're buying negative rates, we're near 0%. But again, our real rate is firmly negative, which is when you factor in inflation and the nominal yield. So again, you're starting to see that pressure. So they're running out of ammo, but the ammo could, they could add new ones. Maybe they just start buying ETFs outright, stock ETFs instead of just bond ETFs. There's a lot of pressure here in terms of what can come next, but you can see that a lot of banks on a global level have very easy policy trying to prop up the economy overall, which has really led to these zombie companies. So the zombie company, as it's derived here, is companies where profits are less than the interest paid on their debts for at least 3 years. And you can see just the inherent grind higher of these zombie companies where there's just really no profits. They're just, kind of treading water, hoping for things to get better. And you can see the last time that this burst was the tech bubble. So the question is going to be, what does this look like going forward as we have these additional headwinds on the consumer, on the lack of spending, on COVID overhang? This is why we keep talking about what was 2019. 2019, we continued to see slowdowns. We continued to see pressure. And now it's just continuing to reverberate through the system, which is why we think that there's going to be a lot of overhangs on not only just the global economy, but also oil demand and just inherent movements on the energy level, which is going to be a problem as we go through the remainder of the year. And when you talk about zombie companies and you talk about movements, we have to talk about China, which is why in the next segment, we're going to do a little bit more of a deeper dive on recent Chinese data.